So you got people, these nameless, faceless people, a lot of whom are what are called neoconservatives in the government, who actually believe that the US, with 5% of the world's population, should rule the world for the next 1,000 years, and that if we have to fight one or two nuclear wars to do it, that's a small price to pay. Because 1,000 years of peace under a United States empire is worth taking a few risks for. There's no guarantee that gold and silver and other real assets like oil and farmland and things like that don't fall initially when the crisis hits. But governments will respond with easier money, and then we'll have a V bottom in those real assets because people will be wanting to buy things that protect against the inflation that they see government policy leading to.
Hey guys, welcome back to Capital Cosm. Today I've got John Rubino, first time on the show. Super excited to have you on, my friend.
Danny, it's great to meet you.
Likewise. Thanks for coming on. And before we get started, guys, I'd like to remind you that we have opened up our Substack, capitalcosm.substack.com. And with all of that said, John, this is your first time on the show, your maiden voyage. I asked this to all my first-time guests, and it is, what brought you into this space? Like, what is your origin story? How did you get into gold and silver and talking about the economy and all this sort of stuff? Like, what brought you here?
Well, I've got kind of a long origin story, and I'll give you the bare bones of it. Is in the 1970s, back when I was a teenager, I became kind of a baby gold bug. I started paying attention to precious metals and read a couple of books by Harry Brown, who was a libertarian philosopher and gold bug back then. And then, there was a massive increase in gold and silver prices in the 1970s. So I was hooked at that point. But I kind of veered around into financial bubbles after that. In the 1980s, I was a junk bond analyst on Wall Street, just as that bubble expanded and popped. And then in the 1990s, I was a tech stock columnist for TheStreet.com, which was at the time, very popular tech bubble kind of online newspaper, just as that bubble expanded and popped. And then in the 2000s, I wrote a couple of gloom and doom books, one about the real estate bubble and one co-written with Gold Money's James Turk about precious metals and, the coming general financial collapse, kind of in time for the great financial crisis to hit. So I've been, involved in financial bubbles kind of inadvertently this whole time. And now I've got a Substack newsletter. By the way, welcome to Substack. You'll love it there. That is aimed at prepping for the bursting of the everything bubble. So, and this is very similar to the 1990s in a lot of ways, what we're seeing right now. So it's kind of a nice bookend for my writing career. Is I covered tech stocks in the 1990s, and now the everything bubble, which is led by some just hellaciously overvalued tech stocks. So here we are. History is repeating.
Yeah, I mean, you see this sell-off in Nvidia, and it appears to be dragging the market down with it. Is this, given that Nvidia is a large share of the stock market now, over $1 trillion, multi-trillion-dollar company actually, do you see this as the catalyst for a big correction in the markets right now, or is this not the big one?
Well, there are catalysts everywhere you look. And the tech stocks in general rolling over could be one of the catalysts for the next big crisis. Because normally the way that the stock market works is there are good times and good times and good times, and stock prices go up and valuations get more and more, stratospheric until market breadth, which is basically a word that describes how many stocks are still going up versus how many are not anymore. When that narrows to a point where there's just a handful of companies supporting the entire stock market, and those companies have valuations that are, 1990s-ish, in other words, like the dot-com bubble level valuations, that's when the market is getting ready to roll over. And we're there now. Market breadth is actually narrower than it's ever been in American stock market history. So we're headed for a bursting of a stock market bubble, which normally leads to a recession. That's kind of baked in the cake by current valuations. But there's other things that could go wrong preemptively and then cause the stock market bubble to burst because commercial real estate is one. A lot of office buildings got built in the past 10 years with incredibly cheap money. In other words, 2, 3% loans to build 100, $200 million office buildings. Those buildings aren't nearly as full as they should be to generate the cash flow to make their valuations valid. And now they have to be rolled over at higher interest rates. So a lot of office buildings are no longer profitable and they're going to come on the market, and they are in the process of coming on the market at way lower prices than they were financed at, which means somebody has big losses that they've got to take. And it's turning out to be the local and regional banks in the US. So we could see a commercial real estate bust that turns into a banking crisis that forces the federal government to bail out a $3 to $5 trillion sector, and that could be the catalyst, which was kind of how it worked in the 2000s. You saw a lot of banks get into trouble because of their derivatives books, and the government had to step in with multi-trillion-dollar bailouts. So that could happen too. And then geopolitics. The minute American and Russian soldiers start killing each other in Ukraine, and we are not far from that at all, or when US and Iranian soldiers start killing each other, that's going to be a potentially financial crisis, because it's a geopolitical crisis. But if it spooks the markets, which it easily could, then that gives us the equities bear market and the recession. And so this list goes on and on. There's a lot of things that can go wrong at this point in the cycle because we've taken on so much debt. I mean, we've never been this indebted before, which is the same thing as saying we've never had this much bad debt out there before. So stuff can go wrong that we're not even thinking about right now, but that could be the catalyst for the next crisis. So all we really know is that the next crisis is coming. We've created the conditions for something really bad to happen that involves real estate and stocks and maybe geopolitics and certainly employment and GDP growth and stuff like that. That's all kind of baked into the cake, and it's all coming in the reasonably near future.
Yeah. So, what do you say to people who have like this kind of like this crash fatigue, right? We've been, people can often say, we've been hearing, this stuff about a crisis and a crash for the past 10 years, 15 years, but nothing's happened yet. How do you refute, those people?
Well, I'd say they're right. This has gone on way longer than it seems like it should have. I mean, a lot of what I just said, you could have said 5 years ago. But in the intervening 5 years, the numbers just got bigger. The amount of debt out there just got more immense, and the geopolitical trouble took us right to the edge of World War III. So, and that's also how bubbles work, because a financial bubble will expand and it'll expand and it'll expand, and people start saying, this is a bubble; it's going to blow up soon, but it doesn't blow up right away. It continues to expand until most of the original perma bears have just either stopped talking because nobody wants to hear what they have to say, or they've switched sides and they're now perma bulls. They're now saying, okay, I was wrong about this going down. I see all these reasons why it's going to keep on going up. You see stuff like that at the peak, and then the bubble bursts. And these bubbles always burst, but they almost always take way longer to reach that point than a reasonable analysis of the actual numbers would lead you to believe. And the thing about this one, I used to run a website called dollarcollapse.com.
Mm.
And on that site, I had a series of articles called The Long Wave versus the Printing Press. And basically, the premise was that, based on any kind of long wave analysis, which takes into account how we have these 70-year cycles in human behavior as human nature basically plays out in the economy. And we get cockier and cockier and take on more and more debt, and then it blows up. And then we have Kondratiev winter or whatever, where it's like the Great Depression. And we are way overdue for that kind of a crisis based on every long wave theory out there. And my theory was that we're able to keep it going longer than seems reasonable, certainly longer than these long wave theories seem reasonable, because this is the first big financial cycle in which the whole world had unlimited printing presses. All the big cycles took place in the past basically in a gold standard environment where money was a real thing and you could build up a certain amount of debt, but you have to go get real money in order to pay off those debts. So the cycle ended sooner. This time everybody can just print currency out of thin air. And that has allowed them another 20 years or so of increases in debt and financial fragility. And so the question then becomes, well, how do we know this is the end? Because why can't they just keep printing money forever? And the answer for that is that we've turned a corner in some very important financial metrics, and one of them is the amount of debt that governments and a lot of corporations and a lot of individuals have taken on, and the interest costs that something like that starts to generate. Because basically, we during the pandemic lockdown, the world created huge amounts of new currency. We increased the U.S. money supply by 40% to 60%, depending on which monetary metric you want to use. That caused inflation. So we had a year of almost 10% official inflation in the US and probably 15% real inflation. And we had to raise interest rates in order to combat that. And that's the point where the interest costs on all the interests or all the debt we built up started to really kick in. The US government's interest cost on its debt went from a few $100 billion a year to over $1 trillion a year, and it's still going up. And I would say that's the death spiral that we've entered now, where you can no longer raise interest rates to normal levels to combat inflation, which inflation is an inevitable result of all the debt we've taken on, because the interest costs bankrupt you. And the same thing is happening in Japan. The same thing is happening in Europe. The same thing is happening with a lot of individuals and corporations out there, that today's normal interest rates are bankrupting huge sections of the global financial system. And so that's how we know this thing is coming to an end, because the tools are going away. The things they've been able to do to fool us can no longer be done because there's a consequence to using those tools. If you create a whole bunch of new currency, dump it in the market, and that causes the economy to grow, well, now it also causes inflation, which also causes high interest rates, which also causes bankruptcy level interest costs. And we're there. So we are now in that death spiral where whatever the big financial players out there do to combat one crisis, it makes another crisis worse. And there's really no way out of this short of the collapse that leads to a currency reset and, the whole Jim Rickards currency reset, or Austrian School of Economics crack up boom. There's lots of terms for what's coming, but they all lead to the same place: a breakdown in our faith in these fiat currencies, and governments of the world concluding that they really have no choice but to go back to some kind of a sound money standard, whether it's the gold standard or a Bitcoin standard or some commodities-based thing other than gold. We'll find out when we debate it and choose something, but we're headed that way at an accelerating pace. So the next few years should be that should be the period in which we have to make our big decisions, finally.
Yeah, I mean, you have all sorts of things jacked up in the economy. I mean, you have this inverted yield curve that's, number one, the longest in history. Number two, the steepest in history, and it appears that it's uninverting, which, as you well know, is a telltale sign that you are entering a recession. A recession is not too far off. My question to you is, John, what does this mean? What does the fact that this was the longest and steepest yield curve inversion of all time, what does that imply?
Well, it just shows we're getting really out of balance when these old indicators that have a long history of working, of predicting something after they've been in place for a while. When the governments have been able to keep things going beyond what they used to be able to do because they have printing presses and they're just willing to print insane amounts of money. But the indicators still do mean something. So yeah, we had a long inversion of the yield curve. Basically, the inversion of the yield curve is basically when short-term interest rates are higher than long-term interest rates, which isn't how it normally works. And banks can't function in that kind of an environment because their business model says they borrow short at a low interest rate and lend long at a high interest rate. So you reverse that, and it's really bad for the banking industry. And we've always already got the banking crisis coming from the real estate bust. So this is a bad thing for banks, and that's why an inverted yield curve normally leads to a recession. But like you said, it's only when the curve uninverts that the recession actually hits. So yeah, it lasted longer this time, but we are at that point where an inverted yield curve is now a really reliable recession indicator. And there's about 20 more out there. Almost everything that you can chart and that has a history of doing something before something else happened, they're all screaming recession right now. The index of leading economic indicators compiles a lot of these things that tend to predict what's going to happen in the economy 6 months to a year down the road. It's been negative for a long time too, almost as long as the yield curve has been inverted. So I think using history as a guide, you have to say we're towards the end of a very long process right now. And so the question becomes, how aggressively are central banks going to lean against this? Because they seem to be starting to cut interest rates right now prior to the advent of a recession. And that's new. So we'll see what that means. But I think it just means that they'll try this thing and then we'll find out that it doesn't work for some really fundamental reason. And then people will lose faith in the central banks because it'll turn out that they don't have any tools left. See, that's the process that we're in. And cutting interest. See, the Fed right now, interestingly, is cutting interest rates, or they're promising to this month in September. Um, at a time when stocks are as richly valued as ever in history, as house prices are as high as they've ever been, and the unemployment rate is still in the fours somewhere, which normally is boom time unemployment. It's a very low unemployment rate. So this is different in that sense that the central banks are doing something that would have seemed crazy in prior times, which is that they're starting to ease monetary policy in the face of a whole bunch of things that look like bubbles. So, it's going to be fascinating to watch from the standpoint of a economics nerd, because we're going to get to see if these theoretical things play out the way we're pretty sure they should, but we've never tried it in history before. We've never done what we're doing right now. So we're going to find out if the laws of finance and economics can be bent but not broken, or if they can actually be broken. And I suspect the bent and broken is the answer. We're going to push things to a point where things really do start breaking.
Yeah, I mean, you have the Fed. This could be a big tell. I mean, you have the Fed now focusing on the labor market as opposed to fighting inflation now. I mean, that was kind of a sleight of hand, but they have pivoted more so to the labor market, which is kind of like an indication that they see more danger in weakening demand, a weakening economy by virtue of a higher unemployment rate, as opposed to inflation. So maybe maybe they're cutting rates because they see the crisis unfolding before them.
Yeah, well, and they do see those numbers. There's a lot of really bad numbers out there that point towards lower consumer spending and a slowing economy. So yeah, the Fed is trying to get out ahead of that. Also, it's an election year, so they're getting huge pressure from the government, the sitting government, to get them all reelected, and the geopolitics thing. It could be that they're recognizing that we're on the verge of World War III, and they want the financial system to be nice and liquid when that happens. So lots of reasons for it to be happening, but they are definitely doing what you said. They're doing this really unusual thing right now.
Yeah, and it's a very interesting point you make. Wars are typically known to be inflationary. So, I mean, does it not seem like adding fuel to the fire in that case? I mean, if we're going to see like a supply, because when you have like these big wars, you tend to see like these supply side inflation starts to form. So, I mean, if they're going to increase liquidity, if they're going to increase the demand side, while they expect a decrease on the supply side, I mean, that's essentially what they did during COVID, right?
Yes. Well, big crises are inherently, well, they're deflationary in their immediate effects and inflationary in the effects of the government's response to them. So yeah, that's what we did. We had a crisis in 2020, and we just flooded the system with cash. And that, we still had a really V bottom kind of bear market where stocks tanked and then they took back off again. But so there was no big crisis financially. And that's because we increased the money supply by 40%. But a war is kind of like that because, as you said, it's inflationary because the government starts consuming a much bigger part of economic output um, to stave off a existential threat. And so you want that not to collide with tight money and cause a 1930s style collapse in the middle of a war that you feel like you've got to win, right? So that liquefying ahead of time makes sense from that point of view. But if it succeeds, that's incredibly inflationary. So we have this choice of the financial system collapsing because the government takes too much from it, or um, the financial system being over liquefied and moving into a really aggressive inflationary stage. And that was also always going to happen somehow, some way by the conditions that were created. Sometime there's going to be a crisis that gives us this choice of a 1930s style deflationary collapse or maybe a Weimar Germany style hyperinflation. And pick one. It's not like we're going to have a bunch of other choices. We're going to have those two choices on the menu. And the government will also almost certainly choose inflation because that's a longer term thing. That gives them a chance. So the guys in charge gives them a chance to retire and then let their successors take on the crisis. Whereas a deflationary crash is almost instantaneous. When big things start going bankrupt, it metastasizes, and boom, you're in the 1930s again, and you, as the politician presiding over it, are this generation's Herbert Hoover. People are going to be talking about you 100 years from now as the guy who destroyed the global economy. So nobody wants that. So they'll always choose inflation. And that's what we're seeing right now. Crisis might be coming. They're getting out ahead of it with easy money. And they will continue to do that. I mean, we could have negative interest rates again in a year if one of these catalysts that we were talking about actually hits.
Yeah, I did see something interesting during the last kind of like contained crisis that we had a few weeks back, which was the yen carry trade unwind. Stocks and pretty much every other asset class fell fairly dramatically. But gold actually held up quite well. Gold actually held up with a pretty strong $2,400 handle. And then you rewind back to COVID, whereas when we had that big crash in 2020, stocks fell precipitously, but gold seemed to not fall as badly. Do you see gold having that quality again once we see, the big one coming up here?
Yeah, gold is where we hide out during a crisis. And to an extent, it depends on the nature of the crisis. Because if it's a deflationary bust, then stocks will tank, and maybe that pulls down everything, right? Because the way it works with gold is if your tech stocks are tanking and you're getting margin calls, you need to sell something that's still holding up pretty well so you get enough cash to cover your margin. And gold would be the thing that's holding up initially pretty well. But if everybody has to sell it or sell silver or the gold mining stocks or whatever's in that complex that you own, then their prices fall too. So there's no guarantee that gold and silver and other real assets like oil and farmland and things like that don't fall initially when the crisis hits. But governments will respond with easier money, and then we'll have a V bottom in those real assets because people will be wanting to buy things that protect against the inflation that they see government policy leading to. So yeah, gold is the winner in most of the scenarios that we now have in front of us. And that's not a guarantee that it goes straight up, but it is a virtual guarantee that it ends up in a higher place from here. But the tricky thing is, do we get another 2008 or 2020 when gold and silver went down with everything else and then bounced back hard. Do you want to be completely loaded up on it during that V bottom, the first part of the V bottom, or does it make more sense to hold off and then potentially risk missing the big run that's coming too? So that, it's an intellectual challenge because you have to figure out how to time this thing right. Unfortunately, you can't just do this thing and know that it's going to work out over the next few years perfectly. So there's still an element of timing in it. But on my Substack, what I'm recommending is that don't try to time it. Just dollar cost average into really high quality names in the mining
Are
space.
you in the market for gold and silver? Then, if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So, not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top notch guy. I wouldn't be recommending them to you if I didn't have faith in their product mode. What you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosm sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosm sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video.
Or use lowball bids where you just pop some unrealistically low number in there and
Mm.
offer to buy 100 shares of something, and then watch what happens in the next, tech stock sell off or Japan carry trade scare or something like that, and see if you get it, at a lower price. But don't just jump in with both feet because some talking head on the internet said, gold is going up to $10,000 an ounce. Because, I think gold is going to do that, but don't take all your money and bet it on that thesis right away. You've got to be patient and got to try to get the best prices possible for what you're buying along the way. So, it's very easy to look at the big things that are coming and say with a high degree of certainty that some of them are coming. But investing for it is still a tricky thing. But it's a thing that it's such a potential gold mine, no pun intended, out there right now. When we really slip into that next inflationary stage, and some of these things just go parabolic. So I'm excited about the possibilities, but still, despite that excitement, I'm still kind of taking my time and easing my way into these things. And I think that's not guaranteed to be the right way to approach gold and silver and hard assets in general, but it's probably the safest way to approach them. And I think safety is incredibly important in a world this chaotic.
Yeah, so that's the gold story. But what about silver? When does silver become more of a monetary metal as opposed to an industrial metal? It seems like it's acting more as an industrial metal as we continue to see weakening in the economy precipitate. Gold's up to its all-time high. Silver's still about 40% off its all-time high. But if you track this stuff on a year-to-date basis, they're both up fairly, fairly in tandem. But when do you see silver taking the stage? And because here's the thing, like the thing with silver is that when we are in a precious metals bull market, right? Silver begins to outperform gold.
Well, yeah, that's how it normally works. Early on, when not that many people are paying attention, but a few are beginning to, capital flows into the big name safe thing, which is gold in the inflation hedge slash real asset space. So gold outperforms silver for a few years. And then two things happen. One is that gold gets way ahead of silver, and people start thinking, God, for 1 crew grand, I can get this whole pile of silver over here. So maybe I'll start buying silver because it's just so much cheaper. And it's kind of the same thing, right? And so that starts happening. Money starts flowing into silver, and it starts to outperform because it's a tiny little market. It's very illiquid. And it doesn't take much money flowing into it to give it huge percentage gains, especially compared to gold. And then silver becomes a bubble at some point at the very top. Everybody's buying silver because what if you can't get any more? And the wait time is 6 weeks already. And what if it goes to 2 years and you just can't get it? And so then silver just takes off. And that is playing out right now. The interesting thing about silver this time around is that even if it wasn't a monetary metal, even if people didn't think of it as something similar to gold, the industrial story would be phenomenal because some new uses for silver have come along that are threatening to soak up basically all the silver that's coming out of the world's mines. Solar panels was a negligible um, source of demand for silver 3 or 4 years ago, and now it's 20 or 30% of the silver that comes out of mines is slated for solar panels. And the new solar panels that are coming along um, actually use more silver than today's solar panels. So the demand from the solar sector is probably going to grow. Meanwhile, silver mines are not producing that much more year after year. It's getting harder and harder to mine most anything. And silver is one of those things where the grades are falling in most mines, and the output is maybe growing, but growing at a very slow pace. And then there's a new kind of battery that people are talking about for electric vehicles called solid state batteries. And their specs are phenomenal. In a lab, they're awesome. And I think it's Samsung that has the newest version, and they're talking about coming to market in a couple of years. And if that happens, and there's no guarantee that it happens because breakthroughs very seldom change the world, at least in a short time period. But if that was to happen, and a new kind of battery came along that uses silver, which these solid state batteries do, then that's a new source of demand that nobody's really paying any attention to now. And then the last thing is, you know, AI is turning out to be this astoundingly big consumer of electricity. Everybody's building server farms that are going to run their AIs and everything, and it's creating this kind of hockey stick graph for energy demand in the US, at least, where all of a sudden everybody needs a lot more electricity because this new thing has come along that is going to use up immense amounts of electricity. And there's silver involved in that story too. So add it all up, and the demand for silver outstrips supply. It's currently in deficit in this market. In other words, more people are buying silver than mines are producing. And it looks like it's going to get worse, barring a massive collapse in the economy or something like that. In the 30s style deflationary crash, this doesn't happen. But in an economy that continues to do a lot of the things where some big trends are embedded right now, there just won't be enough silver to cover the demand for all of this stuff. And somehow, some way, something will break in the silver market. Either some of the exchanges won't have enough silver to cover the futures contract demand when people demand delivery, and they'll default, and that will spook everybody in the market, and the price will go way up, or some other thing will happen that causes kind of a discontinuity in the silver market, where people just realize that the deficit has become a shortage, and you just can't get as much as you want. So you better buy now, just in case it turns into unobtainium at some point. And so, even if silver wasn't a monetary metal, that story, AI soaking up insane amounts of electricity, and solar panels using lots of silver, that story would make silver an interesting commodities play. So you take those two and put them together, the commodity demand rising, and then the fact that silver is very cheap compared to gold right now, and people are going to clue into that pretty soon. And you get a very exciting story. The premiums are still kind of high on silver coins, but I'm still accumulating. I'm still stacking silver coins at whenever it seems advantageous. If there's a little dip in the silver price right now, I buy some more silver coins. And I think that's a reasonable way to approach something that has these two kind of parabolic price chart stories out there that aren't even really related. They're just happening at the same time. And it only takes one of them to work out for silver to be a really good thing to invest in. So yeah, I think the silver story is exciting, and I'm personally gradually getting involved in it.
Yeah. What you would also think would be moving in similar fashion is oil, but oil, given all this political instability across Eastern Europe, the Middle East, etc., oil's super weak. I think it hit a $60 handle earlier today, as a matter of fact. So I mean, given all of this war backdrop, geopolitical instability, what is oil telling us? Is it simply the fact that the economy is just in detrimental shape, that it just can't catch a bid, even with all this risk involved? Or I mean, is there something else happening? I mean, are they just flooding the oil market with SPR releases or something to that effect? What do you think?
Well, the oil story is fascinating because it's got this crossroads that is coming to right now where it's either 150 or $200 a barrel or 40 or $50 a barrel in completely reasonable scenarios. And the high price scenario is that, well, first of all, electric cars are not taking over the world after all. So we're not just going to stop um, making and driving internal combustion vehicles. So we're still going to have that demand for oil out there. And at the same time, like you said, geopolitics is crazy right now. And if we have a shooting war in the Strait of Hormuz, and that gets blocked, and all of a sudden a big source of oil is just cut off, then the price of oil goes through the roof. And that's totally possible. I would give that a 30% probability in the next couple of years. On the other hand, and Doomberg, who is has the biggest financial Substack, has been talking about this a lot, and I think it has some validity. At least it has some intuitive validity. I'm not an expert enough to really, you know, make a value judgment here, but natural gas is in huge surplus in the U.S. Basically, the frackers here have been producing a lot of oil, and that produces natural gas as a byproduct. And so the natural gas price is very low in the U.S., and natural gas is now being turned into petrochemical products. So you build a different kind of refinery, and it can take gas and make a lot of the things that you now make with oil. And of course, you can also generate electricity with natural gas. And a lot of people are going back to that because it actually turned out to be a really good way of generating quick, relatively clean electricity. Um, so you have to start counting natural gas as oil in your calculations of the supply of oil that's out there. And if you do that, all of a sudden there's an awful lot of oil out there. And if you've got such a big supply coming and coming right now and in the future, then it could be that we have effectively a glut of oil in the normal operation of the economy right now. And if that happens, then the price can drop. It drops to the point where it's not profitable anymore to get oil from the Permian Basin or someplace like that. And that supply dries up because those wells shut down, and then it brings it back into balance. But if we're going to take this natural gas glut that we have right now and turn it into cheap petrochemical products in place of oil, then you might have a glut, and that's the story for the 40 or $50 oil scenario. And that, sounds pretty reasonable. We are producing insane amounts of natural gas, and there's no reason that we have to stop as long as oil is at the current price.
What is your biggest concern right now, John? I mean, there's so many things going on: market instability, geopolitical instability. What's front and center for you?
Oh, nuclear war. If we have a shooting war with nuclear powers, which we're kind of blundering into out there, then that changes everything. I mean, we can, all this finance stuff about stock market indicators or the gold silver ratio, none of that matters if we're vaporizing our major cities around the world. And as a parent, I don't want to see my kids be um, incinerated in a nuclear holocaust. So that worries me more than anything else. And the fact that we're blundering into it, just, oh God, okay, as we're blundering into World War III, we've got a dementia patient in the White House, and the vice president is running a campaign where she's traveling around making speeches, but she's definitely not involved in planning for the next big war that we seem to be planning for. So you got people, these nameless, faceless people, a lot of whom are what are called neoconservatives in the government, who actually believe that the US, with 5% of the world's population, should rule the world for the next 1,000 years, and that if we have to fight one or two nuclear wars to do it, that's a small price to pay because 1,000 years of peace under a United States empire is worth taking a few risks for. That's what these guys think, and they have more influence now than they have in the past because the people who have been elected to actually rein in the neocons are, for one reason or another, incapable of doing it. And so that scares the hell out of me that we're in that kind of a situation. We have a non-functioning government, and we're on the verge of a shooting war with Russia or Iran or China or some combination of those guys. So that's the big one. Take that away, and I would say the trend towards authoritarianism also scares me because we could spend this whole show just talking about things that are happening in Europe and Canada, and to an extent the U.S. That are basically governments deciding that they don't want a free discussion of ideas, and they're going to criminalize speaking out against government policy. And the list of things that is happening in Europe and the UK right now are shocking. People being thrown in prison for reposting memes, and in the U.S., presidential candidates saying that the First Amendment is okay, but it doesn't actually it doesn't allow you to say mean things on Twitter or something like that. And, they actually don't understand the concept of freedom of speech or what the First Amendment actually says, and they might be in charge pretty soon. So yeah, this is very scary. We're very close to a kind of high tech dictatorship. We're just a couple of social media outlets away from something like that. Let Twitter or X or Rumble be taken over by governments around the world, and that's basically it. We won't have any other way to say what we want to say. We won't have this conversation. It won't be legal anymore for us to say the things that I'm saying right now. And that's my second big fear. I'm definitely worried about that trend because so far it looks like the quasi-fascists are winning.
Yeah, yeah. Well, this is where we're going to take it off of YouTube, guys. It might get a little spicy here, but if you want to continue the conversation, be sure to check us out on Substack. This is also normally where we would have our Q&A session, but given the fact that we just launched the Substack, we don't have any questions from our members yet. So we're basically going to get questions from my previous guest, who was Simon Hunt. And so Simon Hunt, he had a question for you, John. But before we get to that, I want you to ask a question to my next guest. So if there's a question you'd like to ask my next guest, what would it be?
Okay, let's see. I, you know, you can't tell me who the next guest is, can you? Because
All right.
I
Well,
might
let's.
have something more specific for them.
Well, it's. Hold on. I actually have a couple next guests coming up tomorrow. Let's see which one it is. Okay, it's Mark Faber.
Okay. Because Mark Faber has been talking about globalization for a really long time. And I remember I interviewed him for a magazine article years and years ago. And that was the topic. How is globalization affecting the financial markets? So my question for him would be, is globalization basically over now? Is there any salvaging the system of the last 20 or 30 years? And is there anything worth salvaging from the system of the last 20 or 30 years? or is nationalism our future? And is that a good thing or bad thing from his point of view?
Okay. I'll ask him and I'll let you know what he says. Before we sign off, John, before we sign off on YouTube, that is, drop us all your socials and where people can find you.
Okay, I'm on YouTube or on Substack at rubino.substack.com. And the newsletter that I publish there is basically aimed at actionable ideas for what's coming. In other words, okay, all this bad stuff is out there. How do we prepare for it so we are ready when it happens, and maybe we even profit from it? And so far, so good. Interesting community is kind of coalescing around that concept.
Yeah. Well, all right, guys. That's a wrap on our end here on YouTube. If you want to follow the conversation, like I said, follow us on Substack, members only section coming up. And with that said, I'll see you in the next episode. Bye,
They
guys.
control the NSA, they control the FBI, they control the banks, and so they're trying to make it illegal to oppose their policies. Then came the pandemic, when an awful lot of people realized that this was basically a business scam on one level. It's going to be chaotic. It's going to be, again, fascinating from somebody who obsesses about this stuff, but terrifying from the point of view of somebody who hasn't been paying attention and lives their life. They go to their job, they play with their kids, they hang out with their friends. Now, where you exist, where your refrigerator can record your conversations, your car knows what you're saying within the car, and they know where you're driving, and they know all kinds of other things about you. And the car companies are allowed to harvest this information legally and then sell it. And nobody really knows that. And so, 24/7 surveillance becomes possible when AIs are running these kinds of machines.